Hello again, everyone. This is Dolphin Financial Radio Show, and I'm Dan Wendell. And today we're going to talk about inflation, specifically inflation in retirement. Now, no one likes inflation. I don't think anyone likes inflation. I mean, it's healthy for a healthy economy to have some level of inflation. But the inflation we're experiencing in 2022 and 2021, it's really devastating, particularly for retirees. So we're going to talk about that today. What retirees are facing with inflation, and then what they need to do about it. We have specific things that retirees should do. And to help me talk about inflation is Tony Shore. Tony, welcome to the show. Notice my background. Sorry for the viewers, for the listeners, I mean. You could describe it, Tony. It looks like I have a $100 bill
But it's
burning.
got but it's burning, and it looks like Chinese writing on it.
Yeah, it's got some sort of Asian script on there. I don't know
There's an
what that
Asian
is.
script. It's burning, but it's a Ben Franklin 100.
Yeah, I think
It's
that
a
has to do
it's a
with
Benjamin.
copyright or some sort of you can't show money on TV or something like that, which is why,
Huh.
I drink the alcohol out of the coffee mug.
Giving away all the secrets on today's show, folks. We're pulling back the curtain to see the wizard in his element. He's letting you know how it all works behind the scenes. I love that. No more secrets on the show, huh, Dan?
Well, Tony, switching gears here, throwing the listeners off. So back to the picture here on my green screen. The $100 bill can be saved. It's only about a 25% burn. So I think if you stop it, you could still cash it in. But that's the reality we're facing is money is burning because you don't have anything to show for it. Inflation's eating it up.
That's inflation for you.
Right? Am I right?
Was that Jack Nichols?
I don't know who that was.
Inflation.
That's inflation
Increased
for you.
taxation.
I got all sorts of.
So we've done shows on inflation before, and I want to talk, and maybe we'll repeat ourselves here, but I think it's really important. This is hurting people. People complaining about inflation. It's the big talk of the town.
It's at
Inflation's
least
going up.
8.3 right now. Yeah.
Right. We did a show on I-bonds. I'll put those up there. Those are inflation-adjusted treasury notes that we can look at. I suggest you look at those if you haven't heard of it before. But, inflation goes up, so the Fed says, oh, boy, this is bad. Stock market doesn't like the high inflation. So what do? The Feds don't like high inflation, so they raise interest rates. And what happens when you raise interest rate? Bond prices go down, so no one's happy. It's just a big mess, right?
It is a mess right now. It's kind of the perfect storm, right? Because raising interest rates, raising it just out of control inflation and huge market volatility. Plus, we're still feeling the effects of supply chain issues from COVID and from the war in Ukraine. So it's a perfect storm for people's finances. I mean, we don't like to be doom and gloom on the show, and there's usually things you can do about it, but inflation really especially hurts retirees, doesn't it?
It does. And you're right. It hits retirees more so than people that are working. I'll get to that in a moment.
Sure.
Have you heard the rule of 72, Tony?
Oh, yes. You know why? Because you mentioned it in a show a while back.
I must have. Yeah, that's the only reason.
It's been a while, though. It's been a while.
For those that are no idea what we're talking about, if you take your interest rate that you're gaining, so let's say, you're investing in the stock market, and you want to know how well that's going to keep up with, growth in the future. You could take that and divide it by 72, and that's going to be how long it takes for your money to double, right? So if you're making 7% return, it's going to take you about 10 years to double your money. If you're making 7.2% return, exactly 10 years to double your money, right? So that works that way, but you can also use it in reverse to figure out your inflation, your buying power. All you do is you take what the inflation rate is, divide that into 72, and that's going to be how many years until your buying power is cut in half, right?
Wow.
So normal inflation is 2 to 3%, right? Roughly. Which means that if you divide that into 72, you're looking at about 30 years, your buying power is going to be cut in half. So if you think back to 30 years ago, Tony, how much was a record, an LP that you buy?
30 years ago,
Yeah.
it was probably a used record was probably $5, and now they're way more. And a brand new record was probably $10.
Right. So how much is a used record now?
A used record can go from anywhere. Usually it's between 15 and 20, and a new
Mhm.
record is between 25 and 45.
So it's a lot higher than standard normal inflation. So that means
Yes.
records have inflated higher than just average. Because if it costs $10 to buy or $15 to buy a used record today, 30 years ago it would have cost about 7.
And guess what? Guess when almost all that increase happened on vinyl. Almost
Um,
all of that increase happened within a short period of time. It didn't happen over 30 years.
when the record factory burned.
No, during COVID.
COVID. Exactly.
2020.
So we've seen it,
2020.
right? So let's look at today's inflation. 8% inflation, we'll call it, right? Some
Yep.
will argue it's a lot higher. Whatever, the government has their own ways
Yeah,
of calculating it.
let me jump in and say I read an article yesterday. The headline, it was either the Wall Street Journal. Actually, it was on CNBC.com, and it said wholesale inflation is at 11%.
Okay.
So that's
All right.
different than consumer inflation, which is at 8.3.
Right.
But yes, go ahead. Sorry.
Right.
Thought I'd
So
throw that out
that means
there.
the wholesalers are eating a little bit of it, but passing a lot of it on.
Yep.
So if inflation's at 8%, your buying power will be cut in half in 9 years. Because 9 times 7.2, is 8%, or 8
The rule of
times
72
72.
says,
You divide
wow.
72 by 8%, and you got 9 years. Now there's okay. All right. So
That's
that's
assuming
scary.
that it stays at 8%.
Let's talk about some assumptions here.
Yeah.
Okay. That inflation is going to be a constant percentage. All right. So in 9 years, you're going to have half as much value in your dollar as you do today. That's if we have inflation at 8% every year for the next 9 years. So that's a big assumption.
That's huge.
Will that happen?
I would hope not.
Unlikely, but whatever. But it's important to note that you can't just doom and gloom it that we're going to be penniless in 5 years.
Sure.
The second assumption is that you're getting 0% interest on your money. So yeah, if you put your money in the bank and make 0 in 9 years at 8% inflation, it'll be worth half as much. But that assumes you're getting 0% interest, which you can make that assumption at a bank today. But let's assume you're going to be savvy and not leave it at the bank or under your pillow, right? And then the third assumption is that your personal inflation rate is the same as everyone else. Okay, 8% inflation, Tony. You might have 15% inflation because you spent a lot on records, right? And records may be a higher cost than inflation and everything else. Maybe retirees spend more on healthcare, and healthcare inflation's higher. Or
maybe
they
the
drive a
retiree.
lot.
Yeah, maybe they have an RV. I was just going to say, what if a retiree is driving around the country in an RV right now?
Right.
Their inflation is a lot higher than 8%.
Yeah. So personal inflation rates aren't going to be exactly what national inflation averages are.
Sure.
Right. So
depends on what
these
you're
are
buying.
there's plenty of assumptions here. So let's go through. Well, first of all, why does this hurt retirees more so than anyone else? Because typically wage growth combats inflation. Now, you can argue that we haven't had wage growth in a while. I would say wages have gone up, not as much as inflation, that's for sure. But they've gone up more than the wages of someone that's not working, right? If you're not working, you don't have wages. That doesn't keep up with inflation, so it hurts you more.
Let me check my statement from my check from you. Let's see if the 8% increase in the. Did I get an 8% raise? No.
You think I'm going to waste money on a paper? You must have printed it out yourself. It cost me more to send you your check than it would to in the actual check itself. So
you all printed your boarding passes? Okay, we're off to a bad start.
Love it. So retirees are really up against it. They're up against it because they're not working anymore, right? However, well, Social Security's got a cost of living adjustment, Tony. We might actually see the biggest increase in Social. We had a big one, 5.9%. in
Mhm.
cost of living in 2022.
Yeah.
Will that be a big 8% jump in 2023? Remember, the government's going to try and make inflation seem a lot lower, not only because they don't want to panic, people to panic, but also because they tie the Social Security increases to that number. So the lower the number, the less the government has to pay out in Social Security. So we got to
It's
look
wh
at that with a grain of
it's
salt, right?
yeah, it's why healthcare insurance and healthcare itself, can increase as much as 20% in a year, but the government's, inflation rate is like, "Oh, no, inflation was only 3% this year." It's like, "Wait,
Right,
but I'm paying 20% more for
right.
my healthcare. How did that?"
But we got to remember they have to do a national average. They have to do so everyone's personal
Sure,
inflation rate's going to be a little different.
it's
But I
true.
would argue that when food and gas prices go up, it's going to hurt the lower income people more so anyway,
Yeah,
right? So it's a tough spot, right? There's a tough spot. And we're not going to talk about how to stop inflation. We're going to talk about next strategies to actually help retirees with inflation, right? So let's
yes,
accept that
good.
we have inflation, right?
Oh,
So
oh, we definitely do, and there's even a song about it.
They talk about the U.S. inflation.
yes,
They talk about the
absolutely.
US inflation.
You're not going to be able to get that off your soundboard for a while. We might be in inflationary
It's
environment
true.
for a while.
Might wanna keep that one queued up. Yeah.
Yes. So, first strategy, Tony. Number one thing retirees must do to combat inflation is pay off the high interest debts. If you're paying a credit card interest of 20%, you're not helping, right? Get rid of
No.
it.
Yeah. That's
This goes for
huge.
everybody. I don't care if you're retired or not. Pay off high interest debts. Now, we did a show, mortgage and retirement, right? Um,
Yep.
we'll put that up there. Having a mortgage is not a bad thing necessarily. You might have locked in 2.5%. So
'Cause
that's
that's
not what
low
I'm talking
interest
about.
debt. Yeah.
Right,
No, that's
right.
not right. Yeah.
Talking about paying off high interest debts. Now, not having debt is great. That helps. But if you have a choice, pay off the high interest debt first. All right. So that's a basic strategy for everyone in an inflationary environment is get rid of the
Yeah.
interest because not only do you have inflation buying power hurting, you're also paying 25% to a credit card company for nothing.
Mm.
So get rid of it. Right.
Yeah.
Consolidate, do what
Wow.
you need to do. Okay.
Mhm.
Number two, strategy to combat inflation, maximize your Social Security. I talked about how Social Security has a cost of living increase, right? So a 5.9% increase. Maybe it's going to be 8%. Maybe we'll have double digit increase percentage wise in Social Security next year. Who knows? But it's nice, right?
Mhm.
Social Security,
Yeah.
not only is it backed by the government and has this cost of living, it's also not all taxed. So it's a lot of reasons to maximize your Social Security. And this is the number one. I don't say it's strategy number two, but they're not in any order. This is definitely the place I'd start for retirees or those that are looking to retire. Maximize. Well, Dan, I've already taken Social Security. I've been on it for 5 years. I'm 80. Well, what do you want me to? I'm 75 years old. I waited to 70. I've already done that.
Mhm.
This is nothing new. What do give me something new? All right. Okay. All right. Let's move on to something new. Because by the way, just watch. I'll put the playlist on Social Security. Is the most popular playlist that you and I have, Tony, is about Social
I
Security. Who
know.
would have thought? Would you know
Well
you'd be a Social Security star?
well, the thing is that for those who are, haven't yet filed for Social Security or just filed, there's time within 12 months, and, if you haven't filed yet or you just filed, you wanna watch the show on Social Security or listen to it, because that's money you're leaving on the table if you don't maximize your Social Security. You'll be locked in at a lower rate maybe, so you wanna make sure you're doing everything you can there.
Absolutely. Absolutely. Okay.
But what if it's too late? What if I've already filed for Social Security and locked in a rate? Then what? There's
Then you're
other
cheering for
ideas.
the higher colas. That's what you're doing. But all
Yes.
right, some other things. Stay invested. Okay.
Hmm.
You want to increase the returns on your long-term investments, your long-term savings. Okay. So what does this mean? I've done this show. I want to redo this show. I did a show on retirees needing more risk as they get older. Absolutely counterintuitive, but in fact, it makes sense. As you get older, you need to make sure you still maintain some level of risk because that's where the true returns are. The stock
Yeah.
market's going to be where you get the big returns over time, and that's going to help combat inflation. If
Yeah.
you put
You,
all your money in the bank, that's going to eat up your inflation. That's
or
going
in
to be eaten up by
safe.
inflation.
Yeah. If you have all the quote unquote safe money options and that's where your money is
Right.
at, and you don't have enough in growth, you're not going to keep up with inflation. Even
Right.
later in life, you need to have growth, right?
You need to take some of that money and buy into the stock market. I don't know
Sure.
what percentage. It's different for everyone, and but but it's got to be long-term money. It's not going to be money you're going to spend in the next 2-3 years, right?
Hmm.
You need to go long-term with it, and maybe the stock market volatility is a good thing for you because you can get in at a lower price, knowing that you're not going to touch it for 5 years. That's a
Right.
good plan. Now, the money you have in the bank, you gotta look to increase that too. But you don't
Hmm.
put that if you're gonna need money in 2 years, you're not gonna put that in the stock market, right?
Right.
But you don't necessarily wanna keep it under the pillow either. You might wanna buy a CD, fixed rate annuity, something better than a money under the pillow, which is gonna get totally destroyed by inflation. Even
And
if you
something
get
better than just a savings account.
right, right,
Yeah.
because the savings account's not paying, but if you get 2 or 3% interest on your cash that you're gonna need to spend anyway, without any major risk, that's helping combat inflation a little bit. Instead
Yeah.
of losing 8% buying power, you lose 5.
Right.
Hey, it's not fun, but you can't sit on the sidelines and just hold cash because that's gonna destroy you. Cash is
So
good,
the coffee can in the back of the cupboard full of cash, not a good idea.
not a good idea. But
Yeah.
it's a nice to have that there at some point to pay the bills, but it's also good to say, "Huh, maybe it's time to move that cash in the stock market for the 10-year horizon," right?
Yeah.
Now's a good time for that. But you can't just sit on the sidelines. That does not combat inflation.
Sure. Sure.
Okay. 4th out of 5, reuse your tea bags.
Okay, grandma.
I grew up with my grandmother reusing her tea bag,
Right, I did
right?
too.
I I
Yeah.
I
My
reuse tea
grandmother
bags
did that.
sometimes.
Sure. Yeah.
I'm a big tea drinker. It's
Yeah.
what's in here.
We
It's
actually do that. I shouldn't make fun because of grandma for doing it because we do it in our house too. My wife does that. My wife
I'm
reuses Keurig. She'll get a couple of cups out of the one
oh, I t
Keurig
don't you
pod.
go twice on the Keurig. You go twice. You don't go once on
It's
that.
not
You go
strong
twice.
enough for me to begin with, so I can't do the twice because to me that's just like water the second time. But she likes it.
You cut open the top of the Keurig and pour water in there and just sip it? No,
Exactly.
I I, um I'm joking here about reusing tea bags, but this is always the tried and true strategy, and this is what most people wind up doing is
Spend
save
less.
more, spend less. You
Yeah.
know, when inflation kicks in and you're invested in the market and then the market tanks, you may wanna not pull money out of that
Yeah.
and spend less during this time frame or shift your spending to the short-term assets. Okay,
Mhm.
a bucket strategy, a lot of people call it, or laddered strategy, whatever you call it.
Yeah.
You have some money in the short term, money in the long term. If you have money invested in the market and it's giving you income, you could pause that and take it from a short term source,
Yeah.
giving your investment portfolio time to rebound. But a lot of people will just say, I'm just not going to go on that trip this year. Now, you don't want to do that in perpetuity because you got to live life while you're young. I'm a big proponent of spending while you're young. But if in times of volatility and uncertainty, you may want to hold off on that.
Well,
But
yeah, if you're ever gonna pinch pennies and maybe ease back the spending even in retirement, this year might be the year.
right, maybe depends. But what happens is as you get
Yeah,
older in your 80s, then inflation really can hurt you because you don't have
that's
any
true.
risk and you've been, but usually people spend less as they get older,
True.
right? Except
Yeah.
on healthcare and stuff like that. So if you have your healthcare spending aside already established, maybe you got insurance, maybe you have Medicare plans or something, um, then you can you're naturally going to spend less. Um,
Mhm.
Also, if it's your rainy day fund, if it's raining, spend your rainy day fund, right? This is what it's for. So I think this is not necessarily a a strategy that I'm saying you got to do. It's a strategy that most people do. Like I said, people fear running out of money. I've said this before, but most people don't run out of money because when they start to run out of money, they just tighten the belt and they don't live the life they want to live. So there's a fine balance between not living the way you want to live and running out of money. You just got to find the magic formula there. But that one's not as helpful or insightful. But this one, I think, this last one, Tony, I think people forget about, and we've done shows on it. Don't forget about your home equity.
Mm.
What is one thing that's been happening with inflation? Everyone's talking about, oh my God, inflation's up, stock market's volatile. I don't know what to do. But at the same time, everyone's also saying the price of my home is out of control,
Yeah,
right?
it's crazy what it's worth versus what it was worth.
Right. So people, by default, if you own a home, your home equity's been going up, mostly across the country. There's very few places where home values are going down. And so retirees typically don't have a mortgage. They own their home outright.
Yeah.
And that's the investment. They don't look at it as an investment. They look at it as their home. But that's the place where their true net worth has been going up and up and up.
And they can use that equity to pay off high interest debt.
They can use that to pay off high interest debts. They can
Oh,
use the home
there you
equity.
go. Yep,
They could
back
use
to
home
strategy
equity
1.
to pay the bills while they maximize and delay Social Security.
Yep.
They can use the home equity to stay invested in the market when it's down.
Mhm.
Oh, instead of pulling money out of the market to live, let me pull money out of my house to live and let my investments ride. They can use their home equity to not have to spend less. They could say, I have this money sitting in the home equity. Let me use that so I don't have to reuse my tea bag. So
Right.
home equity is a resource that people don't really factor in. Now, I don't do home equity loans. I'm not a loan officer. I don't do reverse mortgages, but I'm a financial planner and I talk to people about it. Now, home equity is where you usually go on the last resort, but doesn't necessarily have to be if you're strategic about it.
Sure.
Because what good is having this huge asset when you're 95 and you don't don't want to go anywhere and you just, end of life type stuff.
Yeah.
But if you're at 65 and you want to delay Social Security another year and you're like, how am I going to get through this? Maybe you tap into the home equity. God forbid. Right. But it's just a thought, Tony. It's a thought
Sure.
because inflation is going to hurt everything no matter where you are. I don't care if you're invested or not. Inflation is going to hurt that money. So while your home value is going up, inflation's eating at that too. Why not
Yeah.
use it while you need it? Right. You just got to be smart about it.
Yeah. So home equity could be the thing, especially now that home prices are through the roof. Your home value is huge right now.
Mm-hmm. Maybe you downsize and stock away that money in some for long term, some for short term, whatever. I don't know. Maybe you're happy where you live, but you pull the equity out while you're alive to do
Right.
stuff, right? So, conclusion, inflation's part of retirement planning. If you have a retirement plan but doesn't factor in inflation, you don't have a retirement plan. Well, you have one, but it's not good, right?
Right.
It's going to fail. And it's
Sure.
times like this when inflation creeps up, it brings out, like I would say the older boomers lived during that time frame when inflation was 15%, and you can get a mortgage at 20%, and you can get a CD paying you 12, right? They've gone through this, so they've seen this before, and they might start to panic and say, we're going there again, right? The people that are in their 40s right now really haven't experienced inflation. 50s, so it's new, but it's if you don't factor it in, you're doing yourself a disservice because it could destroy your retirement plan. You just got to be flexible. Think about what's going on. Look at all your assets. Don't have an agenda. Just kind of go with it.
Yeah.
Accept it. You can't do anything about inflation. You personally.
Mhm.
You could change your personal inflation rate by spending less on things that are hyperinflation. Maybe you don't go and fix up the house right now because lumber prices are really high. Maybe you push that off. Whatever. But keep in mind that your investments, your retirement plan, your overall strategy needs to factor in inflation.
There you go. Perfect. That's inflation for you.
Yeah, not fun.
No.
I try and make it interesting, but
Yeah.
know,
Yeah. It's
we
a
start
tough
by
time
burning
right
money.
now.
It doesn't help anybody. The image,
Yeah. Picture of burning money doesn't make us feel any better.
right? Well, Tony, thanks for a good show. Quick recommendation. I was going to put a sixth one on there. Stop buying records. That'll help you in the short term.
That's
I'll see you next week, everybody.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Whittle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.